Did you know that if you had invested just $100 in Amazon in 1997, it would be worth over $120,000 today? Now that's a head-turner, isn't it? That's the potential power of investing. It's not just about stashing your money under the mattress, but making it work for you. It's about planting the seeds today that can grow into a thriving financial garden tomorrow. Imagine what you could achieve with the power of investing. But what exactly is investing? Well, imagine planting a seed today, nurturing it over time, and eventually reaping the fruits of your labor. That's investing in a nutshell. It's about setting aside a portion of your earnings now, putting it to work in various financial instruments and allowing it to grow over time. Let's break it down a bit. One of the most common forms of investing is buying stocks. Stocks represent ownership in a company. When you buy a stock, you essentially become a partial owner of that company. If the company does well, the value of your stock goes up. If the company doesn't do so well, the value of your stock may go down. Then, we have bonds. Bonds are like loans given to a company or government by you, the investor. In return for your loan, the company or government promises to pay you back with interest after a certain period of time. Bonds are generally considered less risky than stocks, but they also typically offer lower return potential. Next up are mutual funds. A mutual fund is like a basket of different investments, including stocks and bonds. When you invest in a mutual fund, you're spreading your money across a variety of investments, which can help to minimize risk. Now, here's the key. Investing isn't about getting rich quick. It's about growing your wealth over the long term. This is where the magic of compounding comes into play. Compounding is the process where the earnings from your investments are reinvested, and those earnings generate their own earnings. Over time, this can result in your wealth growing at an exponential rate. It's important to remember that all investments come with some level of risk. The value of your investments can go up and down, and there's always the chance you could lose money. But with careful planning and a long-term perspective, investing can be a powerful tool for financial growth. Investing is about growing your money over time. It's about taking control of your financial future and making your money work for you. So, are you ready to plant that seed? Before you start investing, you need to know why you're investing. Establishing clear financial goals is crucial. It's like setting a destination before you start a journey. Without a clear direction, you may end up wandering aimlessly and not reach anywhere. So, what could be these financial goals? They could be as varied as the people setting them. For some, it could be saving for retirement, aiming to maintain a comfortable lifestyle even after they stop working. For others, it might be buying a home, a place to call their own without worrying about rent. Or it could be funding education, either for oneself or for their children. These goals help shape your investment strategy. If your goal is long-term, like retirement, you might consider more aggressive investments. If it's short-term, like saving for a car, perhaps a conservative approach would be better. Remember, your financial goals should guide your investment decisions. In the world of investing, risk and reward go hand in hand. This is a fundamental concept, as simple as it is vital to understand. When you invest, you're putting your money into something with the expectation of a favorable outcome, a reward. However, there's always a chance that things won't go as expected, and that's the risk. Different types of investments carry varying levels of risk. Let's consider stocks, for instance. They can offer high rewards when the company performs well, but they can also lead to losses if the company's value drops. On the other hand, bonds are generally seen as less risky. They provide regular income through interest payments, but their return potential is typically lower than that of stocks. Now imagine putting all your eggs in one basket, or in this case, investing all your money in one type of asset. If that asset performs poorly, your entire investment is at risk. This is where diversification comes into play. It's the practice of spreading your investments across different types of assets. That way, if one investment performs poorly, others may perform well, balancing out the potential losses. Diversification doesn't guarantee profits or protect against all losses, but it can help manage risk. By investing in a mix of assets, you're not banking on a single outcome. Instead, you're creating a range of possibilities which can help smooth out the bumps on your investment journey. A well-diversified portfolio can help you manage risk and maximize returns. Now that we understand the basics, let's explore different investment options. We have a world of opportunities out there, and it's about finding the one that fits our unique financial goals and risk tolerance. First up, we have stocks. When you buy a stock, you're buying a piece of a company, becoming a shareholder. Stocks have the potential for high returns, but they also come with a higher level of risk as their value can fluctuate based on market conditions. Next, we have bonds. Bonds are essentially loans you give to companies or governments. In return, they pay you interest over a fixed period and repay the initial amount at the end of that period. Bonds are generally considered safer than stocks, providing more stable returns but with a lower earning potential. Then, there's real estate. This involves buying property for rental income or hoping its value increases over time for a profit when you sell. Real estate can provide a steady income stream and the potential for long-term growth, but it also requires a significant initial investment and ongoing maintenance costs. Lastly, let's talk about retirement accounts. These accounts, like a 401(k) or an individual retirement account, IRA, offer tax advantages for retirement savings. The money in these accounts is invested in a mix of stocks, bonds, and other assets. They're a long-term game, and the sooner you start, the more time your money has to grow. Each of these investment options has its unique features, advantages, and risks. Stocks can offer high returns, but come with higher risk. Bonds provide stable income, but lower returns. Real estate can be profitable, but requires significant investment and upkeep. Retirement accounts offer tax advantages, but are a long-term commitment. Remember, it's not about finding the best investment option, but the one that aligns with your financial goals, risk tolerance, and time horizon. It's about creating a diversified portfolio that can weather the ups and downs of the market. Choosing the right investment depends on your financial goals and risk tolerance. So take your time, do your research, and make informed decisions. Your future self will thank you. So how do you actually start investing? Let's break it down into simple, practical steps. First off, you'll need a platform to buy and sell your investments. This is typically done through a brokerage account. Think of it as a bank account, but instead of holding cash, it holds your investments. Opening one is as simple as signing up online with a reputable broker. Next comes the research phase. This is where you'll decide what to invest in. It's crucial to select investments that align with your financial goals and risk tolerance. For instance, if you're saving for retirement, you might opt for a mix of stocks and bonds. If you're a bit more adventurous, you might consider riskier investments like cryptocurrencies. But how do you know which investments to choose? Well, you'll want to look at factors like the company's financial health, industry trends, and historical performance. There are plenty of online resources available to help you with this, including financial news sites, investment blogs, and even social media groups. Finally, let's talk about the importance of starting small. It's natural to be eager and want to dive right in, but remember, investing is a marathon, not a sprint. Start with an amount you're comfortable with and gradually increase your investments as you gain more confidence and experience. So, are you ready to take the plunge? Remember, the journey of 1,000 miles begins with a single step. Investing doesn't end after you make your initial investment. It's a journey, not a one-time event. With every step you take, you need to be aware of the terrain. You're in the driver's seat, so it's vital that you keep your eyes on the road. One way to do this is by conducting regular portfolio reviews. Think of these as your investment health checks. They let you assess how your investments are doing and whether they're still aligned with your financial goals. But remember, the world of investments is ever-changing. Market developments can have a significant impact on your investments. This is why staying informed is key. Keep up with financial news, follow trends, and understand how these might affect your portfolio. Knowledge is power, and in the world of investing, it can be the difference between success and failure. Successful investing requires patience and vigilance. So, stay focused, stay informed, and keep steering your investment ship towards your financial goals. So what have we learned today? We've unraveled the fundamentals of investing, from understanding stocks, bonds, and mutual funds, to setting clear financial goals. We've dived into the concept of risk and reward, and explored various investment options. We've also outlined practical steps to start your investment journey, and strategies to manage and monitor your investments. Remember, investing is not a race, but a journey. So take that first step. Investing is a powerful tool for financial growth, and it's never too early or too late to start.